The Reserve Bank of Australia has just cut interest rates by 25 basis points, bringing the cash rate down to 4.1%. The cash rate has been at 4.35% since November of 2023. But why does this matter to you, the trader? Well, the market moves on interest rate expectations. And if you want to learn more about interest rates and expectations and how it can improve you as a trader, then head over to this video. My lovely co-host Jordan has done a video breaking down interest rates and why they're important to use as a trader. But finish watching this one first. For example, when inflation skyrocketed in 2022, the chances that the Federal Reserve would hike interest rates also went up. That's good for US dollars, bad for US stock markets. And taking a look at the S&P 500, you can see that in that period, the S&P 500 actually had a down year. And that's due to the market's expectations of rate hikes from the Federal Reserve. So yeah, interest rates are super important to the markets. And as traders, when something changes, we need to know about it. If you want to know more about all this type of information and keep up to date, we have a free newsletter. You can find that description, and we cover all this stuff all the time. Now, the RBA Governor, Michelle Bullock, stated that inflation eased a little bit more quickly than anticipated, which is why the RBA has took a stance of cutting interest rates, but still leaving it at a place where they consider it to still be restrictive. But here's what the central bank governor said about future cuts.
For these reasons, I want to be very clear that today's decision does not imply that further rate cuts along the lines suggested by the market are coming. As I noted, we've removed the cautionary increase that we did in November 23 to a level that we still see as restrictive. But the board needs more data and evidence that inflation is continuing to decline before making decisions about the future path of interest rates.
She also went on and spoke about the current labour market conditions and about the fact that they have been stronger than expected, which is why they're leaving interest rates at 4.1% for the foreseeable, simply because the inflation could reignite if we see a stronger labour market. But the key in this is that the RBA is telling us where to focus: inflation. That's why, as traders, whenever we now see Australian CPI or Australia trimmed CPI on the calendar, that's going to be super important to the markets going forward. And if we start to see inflation pressures rising, then that could be positive Australian dollar because they're more likely to leave rates unchanged. Now, let's not forget, we are currency traders. We have to trade in pairs unless you trade in the futures market. But essentially, if you're a CFD trader or a trader that's trading spot FX, we have to trade in pairs. So what central banks are out there cutting rates aggressively? Let me think. Their neighbours, New Zealand. At the time of filming this video, the RBNZ is forecasted to cut interest rates by 50 basis points. By the time you're watching it, they more than likely have cut by 50 basis points, which is a sharp contrast to what's going on in Australia. But that's not the only contrast either. Unlike Australia, New Zealand's unemployment rate is climbing. In fact, it's reached its highest level since COVID of 2020. So the RBNZ's cutting cycle may not stop here or even slow down here at this point. But does that mean we could see a stronger Australian dollar and a weaker New Zealand dollar? Potentially, yeah. When we take a look at the Australian dollar versus the New Zealand dollar, we can see that price has been starting to push higher, creating these higher lows with a resistance band around about the 1.1150 handle. Now, if this level were to break, there's actually quite a bit of upside to be had because the next level of resistance actually rests at 114.50, which were the highs that were found in 2023. And that's a potential increase of 2.58%. Now, let's squeeze in a little bit of seasonal analysis here as well. From the 26th of February to the 9th of March, seasonally, Aussie New Zealand dollar trends higher. It has a 60% win ratio with an average return of 0.77%. Adding this together, we've got two opposing central banks combined with some technicals which are favouring Aussie Kiwi to the upside, combined with a little seasonal analysis as well. So the question is, will Aussie Kiwi break to the upside? Will it go and try and find those 2023 highs? Let me know your thoughts in the comments down below. And if you enjoyed this video, hit that thumbs up, subscribe if you're new, and I'll see you soon. Peace.